Welcome back to the BAI 2024 Investor Survey series. In this second part, we take a closer look at individual asset classes. What drives investment in corporate privates, infrastructure and real estate? And how do LPs and GPs approach these asset classes differently? Starting with corporate privates, we see clear overlaps, but also distinct differences in investment motivations. For private equity, portfolio diversification and capital appreciation are key drivers. Meanwhile, for private debt, the main motivation shifts to regular capital returns while portfolio diversification remains important. The picture of infrastructure investments is more varied. Diversification remains the primary driver for both equity and debt. However, regular capital gains are notably more significant for infrastructure debt than equity. We can also observe that infrastructure is most frequently used for sustainable investments compared to other asset classes. In real estate, the difference between equity and debt drivers are marginal, with portfolio diversification consistently playing a central role across the board. Inflation protection has become less important, but real estate is still a useful addition. Comparing LPs and GPs, their reasons for investing in private equity and debt are almost identical. However, GPs place slightly less emphasis on capital appreciation and more on ESG considerations and market environment factors. For infrastructure, GPs show a stronger shift towards ESG and strategic behavior, while LPs prioritize regular capital gains and portfolio diversity more. In real estate equity, the reasons for LPs to invest focus on portfolio diversification, regular capital returns, and inflation protection, whereas GPs also include ESG criteria and market environment in their assessment. Lastly, when it comes to hedge funds and liquid alternatives, LPs and GPs show similar motivations. The only difference is that GPs give slightly less weight to capital appreciation in their decisions. This concludes our look at the drivers behind each asset class. In the next part, we will analyze how investors allocate into these asset classes and how these trends have evolved over the past years. See you next time.